Hi fools, welcome to another video from the Motley Fool. I'm Owen Benalek. Now Lloyds shares had an amazing run last year. They were up about 60% over the whole year. Pretty amazing. This year they're flat, they're actually down from their peak of about 86p. And perhaps it's not surprising because the shares aren't screamingly cheap anymore. The price to book ratio is about price to multiple is about 1.5 times, and the P is about 11. So not a screaming bargain these days. And that's because even though things are getting better, economy's getting better, house prices are going up, there's less of those payment protection insurance claims that Lloyds having to constantly put money aside for. The market saw this coming. That's why the shares went up 60%. As usual, you've got to be ahead of the market to really make money in the short term like that. There is, however, I think, a good reason to stick with Lloyds, and that's because potentially there's a 6% yield on offer from dividends from the company. Now that might sound shockingly high, particularly if you're a shareholder and you haven't had any dividends from Lloyds for a long time, and that's absolutely true. Lloyds had to cancel all its dividend payments in the aftermath of the banking crisis. However, analysts do expect the bank to pay 2p a year. That equates to a yield, 2p this year, which equates to a yield of about 3%. But things could get a lot better because what the chief executive has done with Lloyds is make it really boring. He's made it a boring bank, and he intends it to be almost like a utility, and utilities pay out a big chunk of their earnings to shareholders. That's what you get. You don't get amazing growth. You get a lot of the earnings paid back as dividend. So let's say it had dividend cover of about 1.5 times. That equates to paying out about 2/3 of earnings per share as a dividend to shareholders. Now, in 2015, which is the next year, analysts expect the bank to make earnings per share of 8p, and if you apply my 2/3 multiple to that, and even round down, you get to 5p. If you even round down from there, then compared to the current share price, that is a yield of over 6%. So theoretically, in just a couple of years, Lloyds could be paying a yield of over 6%. I don't think it will. I think it's probable that they'll go a little bit more slowly and steadily, just to make sure there's no more sort of skeletons lurking in the closet. But let's say it takes a couple more years. The share price will go up as the dividend yield goes up, and so you might end up paying, say, £1 for the shares in 2016. At that point, even if they are paying 5p, obviously the share price has gone up, the yield has gone down. So to kind of lock in the 6% yield now, you'd want to buy now and kind of just hold on to the shares and look forward to a decent income, hopefully for years to come.